We are joined by Professor Max Otte, one of the most prominent academics in the field of value investing, who is also a prolific author and successful fund manager. Max, welcome.
Well, it's a pleasure to be here.
Tell us a bit about your path to becoming an investor.
As you said, I'm an academic first, and I was a management consultant for a while, mostly for public institutions like the UN and the World Bank, and I saw that many of those consulting engagements were really only alibis for something somebody wanted to do. And I'm interested in history and economics and the history of crisis and all this, and at some point I thought, well, if you really don't want to work in an organization, work your way up in an organization, probably value investing is the way to go. Even if you're in today's academics, there's very strict rules, there's very clearly defined paths, there's peer reviews, which I find completely contrary to the idea of research and academics, because if you are reviewed by peers in present time and you have something really innovative, chances are very high they don't get it. And so it's really the case that academics also has become quite bureaucratic. Corporations, of course, have their own rules, sometimes very strict rules, sometimes very narrow rules. So I thought, well, value investing could be a way to go. But I wasn't born with the gene. I was born with, let's say, philosophical, historical, analytical gene. And so it took some time until I became, I think, a reasonable investor.
And what is the, if you can help us understand your timeline, so from your years at the university and how you first started your investment firm, or even when you personally invested money, just to frame a bit the timeline.
Yes, I actually dabbled in stocks at college, managed to lose money in a very strong market, and then lost interest. And then my master's thesis was on macroeconomic policy, especially on currencies and currency policies between the US, Japan, and Germany. Then I got my PhD from Princeton.
And when was that? What year roughly?
It took me a long time to finish it, about 7 years, which quite few people take as long, but I was also pretty much a full-time independent consultant to the UN and others, so it took me some time. And then towards the end of the 90s, let's say 97, when the first symptoms of the tech bubble popped up, I got interested in stocks again and actually made some money, and I've been with stocks ever since. But it took, let's say, until roughly 4 or 5 years ago, let's say 2007, 2008, until I was, in my sense, until my investment philosophy was complete, until I found a philosophy that's completely right for me, that suits me. You also you listen to models and to role models, and you look at them and you think that could work, but every person is different, and really every person needs some modifications in their investment strategy and philosophy to be successful.
So in your case then, what were some of the major influences that shaped your investment philosophy and career?
Of course, well, the first one was O'Neill, who is more of a technical investor but who does it systematically, and he's also publisher of Business Investors Daily, and he brought me back to the idea in, let's say, 96 that there's such a thing as systematic investment. But then, of course, Buffett very early on, and Peter Lynch with his ideas of growth companies and 10-baggers and obvious investments. And both Buffett and Lynch talk about obvious investments. So Lynch was probably the first real influence, then Buffett. And then there was a while when I still was looking around, and then I ran across Bruce Greenblatt, who really helped me clarify my thoughts. He's the He has a Graham and Dodd chair at Columbia University, one of the only respected chairs on value investing at a major university. I mean, the problem with value investing is that you can make a lot of money with it, but academics don't like it because in theory it's very simple. I mean, if you try it in practice, you realize it's not. But in theory it's simple, so there's not really much theory about value investing. I mean, what academic finance people do is back testing. They have some numbers and then they apply them to databases and see what will come out of this approach. And there's been thousands and thousands of those backtesting studies, let's say price to book or price to book momentum, or combine some ratios and then see what comes out of it. And all of those are basically wrong, because we always look at the future, and the past is never a guide to the future. So Bruce Greenwald clarified my thoughts. Lynch and Buffett got me started. Then, and Bruce Greenwald, let's go back one step. So Lynch got my interest going. Buffett shaped me in many ways. I come back to that. And Greenwald actually helped me to clarify that one does not only have to look at the obviously great investments, the franchises, the Coca-Colas of this world, but that there's a whole universe of companies one can look at, average companies, mediocre companies that have a reason for existence, as long as they're not fundamentally going out of business, like let's say car companies or telecoms or whatever. One should look at them too, because they're in the majority. 90% of the companies are average. I mean, that's the rule of numbers, and Greenwald helped me to make a distinction between great companies and average companies and find ways to look at each of them appropriately and invest in both of them.
Just on that point, average, yes. Average meaning there is no lasting competitive advantage. Is it in that sense that
exactly
average was
absolutely exactly? And as simple as it is, for such average companies, the book value or the adjusted book value is a good measure of value. And the other one is then sustainable earnings power value. You take some average or sustainable earnings and apply a multiple to them, and then you get another pretty decent valuation. Those are very simple valuation procedures, and that's the other thing Greenwald told me. Never use discounted cash flow. Keep your valuation extremely simple, because the mistakes you make come in your assumptions before the valuation. You assume too much growth, you overlook something in the industry. So the mistakes are much more qualitative nature or logical nature, of a logical nature. So you can do actually with relatively simple valuation procedures and spend your thoughts on things that come before the actual valuation.
And if I remember correctly, you were teaching Bruce Greenwald's seminar on value investing in Europe.
Yes, he's a great guy. He said, I don't want to travel so much to Europe, so you teach it in Europe if somebody's interested in it. Because it's something else, yes.
And do you still teach that course? Is that still available to be attended, or?
I do teach it if there's interest in it, but right now my businesses and my publications keep me so busy that I haven't actively made it available. But if there's enough interest, I will teach it again.
And I know that you have also set up a fund called PI Global Value. So can you just bridge now from the experiences in academics and the lessons you've learned from such investment greats as Bruce Greenwald or Warren Buffett, to how did you start your fund, and what was the genesis to that?
Let me go back to one or two more influences, because I just really talked about Greenwald. And there's, now let's go back to Buffett. Buffett really tailors his communication strategy to the situation he's in. So, because he wants you to be a long-term investor in Berkshire. So he doesn't tell you everything. What he tells you is generally true, of course, but so when he talks about the Coca-Colas and he says that he kept it in 2000 and in retrospect he was wondering why, because it was too expensive, he omits that of course he couldn't have sold it that easily. So one has to listen to Buffett also from the situation he's in at the time. He's been doing private equity mostly for the past 10 years. He ran a hedge fund, which was a Buffett partnership, so he's done everything. But what I really also learned from Buffett is that keep it simple. He repeatedly said the investment opportunity should scream at you. If you need a pencil and paper, it's too complicated, and he repeats that. And fact is that people don't believe him. Well, I do. I think he really does many decisions very, very much by simple rules and procedures. He just waits long enough for the perfect moment. And the other thing he does is he trades. I mean, he can't trade as much because he's too big, but when he was younger, he traded a lot. So I trade a lot. I trade a lot in positions I know. And the same is true, for example, for my last influence, which is Best Inver from Spain, a fantastic fund. They've been on for slightly more than 20 years and have outperformed by 5, 6, 7%. And they have a relatively limited universe, so they go bottom up. They know their companies, but then if they think they come close to fair value, they're not above selling and then buying them again if they fall and selling them again and so on and so forth. So, and Buffett and Best Inver and so on, also my circle of competence. I have a universe of a couple of hundred companies I watch, plus some on the periphery. And I do this let's say manually. I have no databases. I have no complex sorting software. I just have it in my head, and I'd rather go for very clear-cut decisions, very simple situations, and I found that quite a few investors want to dazzle with complicated investment thesis, which is fine if they make money, but I'd rather go for the simple thesis. If it screams at me, I do it.
Well, that makes a lot of sense to me. So is that how you then, from these influences, you mentioned how they shaped your investment philosophy. So can we just go into more detail? What is that philosophy then, and what is the investment process in practice? Perhaps how you employ it at the PI Global Value Fund.
Right. I think that Bruce Greenwald made a very good summary of an investment process. First, you have to have a philosophy or a method of asset allocation. Second, you have to have a search strategy, how to search for good investments. Third, you have to have robust valuation procedures, not complicated ones, robust ones that hold under various scenarios. And fourth, you have to have a disciplined method of buying and selling. And so my fund is basically a long-only Mischfonds.
It's a hybrid fund.
Yeah, long-only stocks and bonds fund with a bias for stocks, because my neutral allocation, if I think the stock market is fairly valued, I would be 100% in stocks, because even in a fairly valued market you'll find cheaper and you find bargains. Only if the market is overvalued, it gets much more difficult to find bargains at all, then I would go out of stocks. So, so that's and I do that on a relative basis. I do the Benjamin Graham criterion, basically looking at if the earnings return on the stock market is twice above the bond yield, I would go for stocks, and below I would start maybe going a bit into cash. The other valuation method would be Buffett's, roughly compare valuation of a market with the country's GDP. 100% would be roughly around fair value. So those are rough figures, but they work. I mean, I'd rather have rough figures to give me an orientation than very complicated ones. points. The last one is book value. If the stock market is slightly above or at book value, it's of course rather reasonable. That helped me also to stay invested in the past 3 years, because I found so many bargains that I really never significantly went to cash, and it paid off. But you have to have that insurance and that assurance and that certainty why you do this. And I simply thought I should stay in stocks, and I did. And it was the right way to go. So that's the first step, the asset allocation. And then, of course, the second step, the search strategy. As I said, I'm not running complex databases. I looked at price to book. I sometimes look at relative loss in a market, companies that lost most. Then I have a universe of maybe 400 stocks, the German stocks, European stocks, some US stocks, very few emerging markets and Japanese stocks, no Chinese stocks, well, 1 or 2 maybe. And those are in the back of my mind. And then I look at which market is cheap. I think Europe is cheap in general. Southern Europe is dirt cheap. Japan is cheap. The US is not cheap. It's not dirt expensive. And so on. Then one thinks about where to focus the further search efforts. And then one goes someplace. And it's very much, of course, a process that looks for opportunities, that doesn't care much about sector allocation, country allocation, and those things. I manage risk, I can come to that later, but not by sector allocation or by country allocation.
Mm-hmm. And before we get to the third point, just can you help us understand a bit, you mentioned the number of companies, it's in the hundreds that you monitor, and you're very familiar with, it seems. So how does a company make it to your list? Is it a function of you getting comfortable over a period of time following these companies and they make it onto your watch list? Can you just help us understand better how you build that base of companies?
Well, it's not actually a watch list in that sense that I keep track of those 400 companies. I was just saying it's a rough number of companies that move through my universe. So most of course, the major European blue chips. In Germany, Austria, Switzerland, it's also blue chips plus mid caps plus small caps, because those are my home markets. I don't have a home market bias, but I happen to think that we have good hidden champions in the smaller mid cap sector. So, I mean, and many of these companies have been, or I have known many of these companies for 20 years now. Let's say BMW or Fresenius, the dialysis provider, or many others of those. So they're just there, and they're in the Eurostoxx 50 companies, or some English companies like Capita Group, the services provider, or lots of US companies. So I just have those. And occasionally, let's say I let the radar move, which again is not a formal database, but I look at, have certain sectors stayed behind, is there a reason for it, have others advanced, where could cheap stocks be, and then one looks deeper. So it's really, in some ways, a top-down process to guide the research, or to guide, let's say, the ideas where I'm looking at, or where to look. But then, of course, I go very much into the fundamentals of the company. Let's say if you know BMW, and you know they're a great company, they're a leading company, they have lasting, at least some advantages over some of their peers. So it's a difficult industry, but in that they're very good, and they've been good for a long time. Then it tells you something, and then you only look for the deviations from the expected path. Another thing is, if I really have to go into something that has been interesting to me for a while, which is Japan, and where I really don't, I know about the political system, I know about, but really it's not so easy to read the financial reports. But I've been interested in Japan since, let's say, 2007, and finally I started to look at some companies, and then I bought some right before Fukushima, of course. But again, I mean, that's the macro picture. Japan has been cheap for 20 years. It's the third largest economy in the world. It's an excellent economy. There's lots of negative sentiment. People tell me, well, they should earn they should earn more money, they should have higher earnings and so on. Okay, so earnings have been depressed for a long time. I mean, of course, it could be a perennial earnings trap, but I don't think so. I mean, if you buy below book with lots of cash in the balance sheets and so on, if it's really cheap enough, I'm not scared by that.
Mm-hmm. And so it seems, are we right to infer that for you it starts more with the business itself and getting comfortable with understanding the business versus running quantitative screens necessarily and constantly looking at new companies? You have the businesses that you identified as businesses that could potentially create value over time, and then you're looking to find the best way to buy these businesses at the best price and so forth. Is that
yes, it's the stories. It's the stories of certain markets, but mostly of businesses. It's the story of industries. And I mean, once you have some idea about what the major issues, let's say the pharma industry is the pipelines and generics and the biotechs and so on, how it's structured. And then you see pharmaceutical companies coming down for years. I've been buying them since 2006. They came down a lot more. I've bought more. But at some point they're in prices and they're relatively stable businesses. Of course, they're not growing anymore. But and so if you know a few industries, if you know a few regions and so on, there's no need to constantly look for new places. I mean, I did make an effort to go into Japan, but it's been the only such conscious effort in the past 2 or 3 years. I'm not looking much at emerging markets. And as you say, it's value creation in businesses, yes, but it doesn't have to be permanent value creation. I mean, if you think about mean normalization with some of those Japanese companies like Sony, which is very depressed, of course they've had not so good business decisions, but they have competent engineers. They're a world company. They have brands. So I wouldn't bet on them for permanent value creation, but at this price they're good for 60–70% and then they go out. So I would do that too. I would not only look at companies that are bound to create value over a very long period of time. I also look for these normalization opportunities in prices.
Mm-hmm. Can we perhaps go into more detail with a particular company from the past or something that exemplifies best how you approach investments? Just walk us through an example of what's worked out that best exemplifies your investment approach.
As I said, there's basically two approaches. There's the long-term value builders and there is the companies I do trade. If I think they're maybe mediocre businesses but at great prices, I would buy them. And let's see here my recent 2011 trades. For example, I sold, Allianz Insurance, Germany, much cheaper than US insurance. Of course, they have Solvency 2 and 3, so they have things there. They have potential inflation risks. They have risks in their bond portfolios. They can't invest in stocks as much as US companies, so all of this. But they're a really global company. They've been around for over 100 years. They're the market leader in Germany. And so if PE goes down to 5, 6, if dividend yield goes up to 6–7%, I am knowing those risks. I'm willing to buy without too much analysis. The stock comes from 440 euros in 2000. It went down to 44 in very short periods in 03 and 08. Yes, 08, fall of 08. So I got in and simply bought it because I know that this business will be around. even when they have difficulties in their bond portfolio. I mean, guidelines don't allow them to invest very smartly, but they don't do anything, let's say, stupid or make major mistakes. So I bought them and then I sold them again, if I can see this here, early 11 at a gain of 15–20%. So I'm not above those trades if I find them attractive. And my buying and selling decisions are always relative decisions. So find us something else at this point that is more attractive, a lot more attractive, then I would sell maybe and realize a gain and buy the other thing.
Can you just, with Allianz, just you mentioned that to you it looked cheap versus its US peers. Perhaps just walk us a bit through the thinking there. What sort of metrics would you look at for an insurance company? On what basis was it cheap to you?
Right. One thing is, of course, book value. It was way below book value, and that is a clear indication that it's really cheap. Again, it's been one of those companies where I'm fully confident that it has honest management, it doesn't have the smartest investors. So book value alone would tell me a lot. And if we have relative price decline and we come to a fraction, I mean, let's say 70% of book value, I know it has an easy 30, 40, 50% upside. And really, I mean, and I look at a bit at PE and margins over the long run, and those have been relatively stable, although of course the investment portfolio is not throwing off too much. But that's really already just confirming, and basically in that sense the book value was almost enough to me. It's simply the Buffett saying, does it scream at me? Yes, it did, simply on the basis of book value, and plus the fact that I know, or that I'm confident that they are very unlikely to do something AIG-like, and that was enough for me.
And that was borne out in the, I know you mentioned you don't look so much to the past and the financial statements historically, but certainly for an insurance company, would it have been interesting to go back and see that there were no major impairments to book over time, or how the return on equity was over time? Is that something that you looked for to get more comfort before you made the investment?
Not really in this case. Let me pull up my some figures here. So the impairments, of course, there's always some, or occasionally some, so that's normal. But let's say if I look at the simply, so there was a big impairment in 06, but let me see if I have some idea of average earnings, that would be enough for me. And I don't care really, or in this case I don't care, because I know they're around, I have a lot of market clout, and if I think they're below fair value, which I put at book value plus it's 10 to 15%, then this was basically enough for me. Mm-hmm. In this case, I mean, I just wanted to give you an example where I basically made a trade fairly quickly on a very simple basis.
So you would not have stuck around for long-term value to build, and you mentioned the two categories, the long-term value builders and more of a trading opportunities, so this would fit more into this second category. Right. Is that right?
Yes, Allianz to me is a perfectly legitimate business. If it will build book value over time, is questionable. I mean, they since let's say '98 they doubled book value. That's okay, but it's roughly keeping up with inflation. It's not much more, well, a bit more, but so they're not really a long-term value creator, but they at least preserve value to some extent. And if I get a company that preserves value at a quick shot, much cheaper than what it's worth, and I just jump in.
Mm-hmm. And was there any consideration given to management, and can you just walk us through how you assess management? Is that important to you at all?
Yes, it is. And in this case, I mean, I have a former intern or study colleague who interned with me a year or two younger, who is now CEO in Switzerland, but we don't talk. I mean, I just know, I know he took this career, maybe we'll talk at some point, but we didn't in the past 10 years. And I know that the CEO, Mr. Diekmann, is from my home region, which normally brings, creates quite, let's say, stubborn, down-to-earth people. And he started with the Allianz, and like all trainees, he had to sell products door to door. Of course, he studied, he got a master's or a doctorate, I'm not sure, and then he gives very few interviews. He says, my time is my employees and my clients. And I mean, Allianz always had a very down-to-earth management and a very conservative management. And I know that it's been like this for a long time. And Diekmann, who's been in for 4 or 5 years now, had really continued that tradition. So I'm very comfortable in that regard.
Mm-hmm. And do you know, did Allianz then have to raise any significant new equity through 2008-09?
Twice, yes. 2003 and 2008, they did capital increases pretty close to the bottom, which was also not ideal. But again, I take this as coming with the business, and if I get the stock cheap enough, it doesn't bother me.
So the key for you in this case was just your assessment that there is this intrinsic value, and that you were able to get it at a big enough discount to get involved.
Right. If the safety margin is big enough, I do almost anything. Not anything, but almost.
Can we maybe talk about another case where perhaps it didn't work out quite as well as you hoped, and perhaps walk us through why was that, and are there any lessons that you've learned from it?
Yes. Before I go into one of these painful things, I have a general lesson for myself, and I even last year I still fell for it, and one shouldn't. I mean, always when somebody else proposes something at a conference or gives you a tip and is really happy about these things, and it all sounds so nice and well and right, and you think you should do that too. You look at it cursory, you probably have already made up your mind before you look too deeply. So very often when I listen to others, I had a problem. I have a small group of companies, and I have in one of my companies I have a colleague, so we have he runs a fund, I run my fund, so we exchange some ideas, and and also listen to others. I mean, I guess I pretty much emancipated myself from it in the past 3 years, but I still, every once in a while, you make that mistake.
So the mistake of essentially not doing your own homework, but to get
maybe doing biased homework. Somebody praises it in the highest things, and you think if he does that, maybe you can skip on some of your homework, or, and so on and so forth. And that, I would say, I haven't really counted the times, but I would say there's a clear confirmation that those things in general work out badly, or on average work out badly. And one of these things was Carrefour, for example, where my colleague was very much in favor. And
Carrefour, of course, the French retailing
hypermarket chain
giant.
And I looked at it very cursorily, and I thought, well, it's much cheaper than I know they have some problems with management and so on, but they have a market position in France and some other countries, They did have problems in Brazil and Latin America, that's all clear, but I thought, well, look at the metrics. If they manage to get earnings up a bit and so on, I should buy it. And I bought at 33 euros. That hurt because it's now after a spin-off or two spin-offs, it's at 17. I did get out though at partially at 33 again, and partially at no, I did get out at, let's see here.
So did you then when you
I did get in at 34 and 32, and I realized something was wrong, and I did get out at 31, as I see here. So I made a small loss on the position. I guess it was a classical case of buy now, analyze later, which sometimes works and sometimes doesn't. So I tried to discipline myself there.
And what specifically do you remember forced you to make that sell decision even at a loss? What was the red flag, if you will?
Mm-hmm. Unless this sounds too let's say too careless, I have 75 positions in my fund. I run it myself, and I realized after I bought it, it started to slide. I didn't really know enough about it, so it was really, I looked into some of the issues. I really felt not comfortable enough. So in some ways it's a good counterexample to Allianz. Both are European market leaders or large market leaders, and I'm very comfortable with Allianz in general, although it's not really a value-creating company. But with Carrefour I got more uncomfortable, and I didn't have the time and guts to, or the time to really do due diligence, and there were so many other positions that I liked. So I said, well, maybe I'm not so comfortable about this after all, so I got out again.
Mm-hmm. Mm-hmm.
Let me see, maybe I have a third one here. One where I'm very comfortable with is Celesio. Celesio, the German European pharma retailer or wholesaler. He is a European market leader seated in Germany, long-term history of value creation from the 80s. They also run about 3,000 pharmacies in England and France and other countries. In Germany they can't because of regulations. So it's really a diversified company in a tough environment with very slim margins, 2.5%, so really slim margins but stable. And that company I know very well. I'm not so sure about long-term value creation or really massive value creation, but and they've had 6-7 tough years now, but they have a very legitimate market position, and book value kept increasing, and they're now traded at book value. They were traded below a couple of months back. And Celesio is one of those. I sold my position in early 2011 at around 18.42, simply because I thought, well, it's moved a bit closer to fair valuation, which is maybe 23, 24, so we're still some time off. I still sold at a safety margin, but I found other opportunities. So I said, well, let's take a profit. And then I started getting back into it 3 or 4 months later, when it had slid by, let's say, €2, and I bought at 16.60, and then it started sliding. 17, 13, I bought more. 12, I bought more. 10, I bought more. 11, I bought more. 9.94, I bought more. So I'm now at I have an average entry at 14, and I'm now break even, and for Silicon at 20, I have made an easy let's say 30+%.
Can you just Sorry, can you just frame it for some of our listeners who may not be as familiar with Celesio? Just what was the reason that the share price had, first of all, run up, come down? Were there any fundamental business reasons behind it that made you take notice that it was an opportunity? Or can you just walk
Well,
us through that?
there's a long-term decline. They were at 57 euros in '07, and they were at 10 at some point last year. And but as always in stock markets, it goes down, goes up. It is not a straight line. There was quite huge swings. I mean, this is a mid-cap stock, a few billion market cap, and so I simply took, since I know the company, it's the same as with Allianz. I feel comfortable with it, other than Carrefour, which I also know but not well enough. I simply, when I buy and it goes up and other things go down, I reallocate. And I react in that sense to price movements, which I find, as Mr. Market so often does, irrational. But there is a expectations about the stock are fairly low, although they have a good majority owner, the Haniel family, and they've had a string of bad years, tougher regulations, tough markets, all this, but they still have a legitimate business, they still have a good management, and competitors are in the same situation. So I simply took advantage of the swings in stock market price.
And just to understand a bit better, Celesio, can you just talk us a little bit through the business model? Is it focused on branded generics? Are there any tailwinds that may favor its earnings over time?
Well, it's really tough business. I mean, they're really wholesalers for pharmaceutical stuff. So they have stations all over Europe or in the countries they serve, and it's really they compete on the basis of logistics and cost efficiency in their core business, and it's a tough business. But they're the largest, so they have an advantage, economies of scale. Plus, they started to develop tailor-made services to, let's say, homes for elderly or hospitals, so they deliver just in time and just deliver the right things right to the patients and so on. So they experiment with those value-added services, but that's not really taken off so far. They also bought something in Brazil, so they're expanding overseas, and also they have that retail, so to say, branch with the huge pharmacy chains in France and Britain, and at some point the company is valued below simply the sum of the parts of those pharmacies. I mean, so in many ways the valuation is cheap, very cheap, the business is legitimate, but many things have gone wrong. Their entry into the German pharmacy retail businesses have been blocked by regulators. It's still forbidden. They've had earnings problems in Britain, they've had this and that, so that's why the expectations are so negative.
And do they make their money then on rebates from manufacturers of pharmaceuticals? Is that the main revenue source?
Right, the spread, I mean the spread for what they buy it from and sell it from in their main line of business. And then of course there's the other line, which is not insignificant, which is the straightforward pharmaceutical business, pharmacy business.
Mm-hmm. Mm-hmm. And certainly the price swing has been quite significant. I'm just thinking, could it be also due to a weak balance sheet? Was there any risk from the balance sheet in this case? And
well, there's been some, of course. I mean, they're of course capital intensive, so they have debt levels and so on. But again, one could go into a very deep analysis. It's nothing exaggerated, nothing really too big and bad for a retail and wholesale company that has to carry that inventory and so on, and infrastructure. So that was okay. And then again, I mean, one could analyze, but if you realize that they have had a long-term owner, the Haniel family, for decades, and they've raised a special bond convertible last year, and that went fine, and so on. And you know, another thing is that analysts don't really like to cover them because they have no peers. Their two competitors are held by private equity, and so analysts are really also herd animals, and if they have no peers to compare, often analyst coverage is lacking. The same with Berkshire, and so but I've simply known the company, and they do good business. They have good owners. There's nothing, let's say, dramatic in the balance sheet. The margins are thin, and this is enough for me.
Mm-hmm. And just lastly, perhaps to pinpoint exactly on the valuation, so what metrics did you look at specifically here, and on what basis did you decide that it was cheap enough for you?
Again, price to book was one. When I saw them 20–30% below price to book, and I looked at their average margins, so to say, then I said, and let me see if I find it right now, then I can get to my upside that I computed for it. Just a second.
So you would have looked at both an asset-based metric as well as maybe a normalized earnings figure that you could get comfortable with, and then applying.
Yes. That is something that Greenwald also teaches you. Do an asset base, adjust the balance sheet to put in, I mean, let's say intangibles. So you put a value in intangibles. There's some ways you can do that relatively simple by maybe doing multiple of R&D or multiple of SG&A and so on, and industry specific, and then also do a normalized earning. And just when at some point the equity was about 2.5 billion and the equity was around 2 billion, and my fair value was around twice of its market value. That was 3 months back, so maybe by now it has risen somewhat. The upside is another 60% or so.
And that is on the basis of normalized earnings.
Right.
Okay.
Right. Mm-hmm. And it's above book value, but not much.
It would be above book value based on your intrinsic value estimate, not currently. Is that right?
The intrinsic value estimate would come out slightly below. There's no way to do this exactly without coming slightly below my earnings power, and the book value as stated in the balance sheet would come out somewhat more below.
Mm-hmm, mm-hmm. So a slight premium to book is where you would look to sell it again.
Yes, or I also would sell it if it's stayed where it is or moved up a bit. Let's say 20%, and something else got so dirt cheap that I just needed some funds.
Sure.
Sell it.
Sure.
Relative.
Perhaps let's get back again, perhaps, to your overall portfolio. And you mentioned about 70 holdings. Is it that you have?
It's rather 75 right now. I'm trying to cut down, but we'll see how. It's still the candy store Buffett talks about. So if you're in a candy store, it's hard to discipline yourself.
Mm-hmm. And have you? So does that has that changed over time, or have you been more concentrated, or is that how you basically run your fund?
What I've done this year is I saw Europe fall in value all the time, and I saw Southern Europe fall even more. And I'm comfortable with Europe. I know my companies, so I really moved into Europe and Southern Europe big time. I have almost no U.S. positions right now because, yes, it's a great economy. Yes, there's some bargains there, but there's not so many bargains. And Europe is full of bargains. And Southern Europe is one whole gigantic bargain. Greece and Italy at 20%, market capitalization at 20% of GDP and so on. It's amazing. And so I started buying European companies, southern companies, which I know, like Benetton, which is not really doing too well operationally, but it's not a turnaround case. But it's just cheap. It comes from but I've done this in measured doses. I've done 0.5% here, then I've stocked up when it fell further. So right now, this is my way of dealing with risk, to be fairly diversified, but in terms of companies, not in terms of countries. I'm focused really on the Southern European countries, on Europe in general, and I'm hedging against risk by spreading around among various companies.
Can I pick up on that and talk a bit more about just how you manage risk in your portfolio? And can you first tell us a bit about the type of the fund structure? Is it an open-end fund? And what type of investors do you have? So does that influence the way you manage the portfolio?
It's an open-end fund. It's traded once per week. Fees are 1.5% for private, 0.8% for institutional, above 5 million. I just have 3 institutional investors, which make up about 20%, 25% of the fund, and the rest is really private investors, and I'm very happy about this. I have a good media presence right now in Germany and some other countries, and so I get private inflows. I get small investors, and I really want to serve the small investor who wants to have the trusted stock investor and stick with it long term. And so that's really my target audience. And if institutional investors are interested in this, they're very welcome. I've made the experience that family office managers often really try to cover their neck first, but are not so much interested in the issue of investing itself and fundamental long-term performance. There's a jargon, there's also almost a bureaucratic jargon about fund of fund or fund manager selection, and I don't like to play that game. I like to talk and address the final decision maker, be it an entrepreneur, be it an entrepreneurial family office manager, be it the individual small investor. So I'd like to talk to an investor directly or communicate directly. So that's the fund right now is about 73 million. We're pretty optimistic we'll grow to 100 million pretty quickly, and so that's the structure. Again, from the beginning, it's a mixed fund with a stock bias. If stock markets are fairly valued, I will still be 100% in stocks normally, but I can go to bonds if I really have no ideas anymore.
And I know you also have invested in gold, and can you just walk us through also how you manage money for your investors? Do they could they be well diversified by just having their assets with you, or do you basically serve as one of their overall investment needs? And
yes.
How do you think about that?
Let's say it is in some ways an actively managed fund, in the sense that I try to take the situation, the valuation of markets into account, but really it's for somebody who primarily wants to participate in the stock market. So it is a stock market fund that has some other options. If stock markets get too cheap in special situations, so I would try to protect the fund's value by, let's say, going into bonds or even into gold or silver. Since I have the permission to distribute it in Germany publicly, restrictions on gold and silver have become more strict. Authorities think that it's very risky to have physical gold and silver in the safe, which we had before. We had physical gold and silver. We cannot do that anymore. That was one of the conditions to be publicly available. And so I could only buy one-to-one ETFs. I'm not a great fan of ETFs. They're synthetic products. I mean, the one-to-ones are okay. So the best thing to describe it is for the investor who wants to participate in the stock market, but wants the fund manager to acknowledge that stock markets are expensive, to be able to step back from the stock market.
Mm-hmm. And when we look at the events in 2008 and 2009, has anything changed in the way you do your risk management in the fund? Have any of these events changed your philosophy around that?
Well, as you know, I predicted pretty much the subprime crisis as early as 2006. And
you have written a book, that is titled "The Crash Kommt" in German, essentially predicting the crash. That was published in 2006, wasn't it?
Right, right. And it predicted a financial tsunami based on U.S. subprime sometime between 2007 and 2010, and most likely 2008. And so in that sense, it was, I was very happy I wrote it, but when I started in 2008, I looked at the market metrics. I still was very heavy in stocks. And my first investors had to accept losses of 35%, but I have very loyal investors, and 3 years later, let's say a bit more than 3 years, no, I don't know, 4 years later, they were 56% in plus. So from the bottom, I made an easy 150% very quickly. And that tells you that I'm not really looking to macro events so much if my valuation metrics are right. What I did in the past 2 years is, as I said, I went to Europe, last year especially, and generally I manage risk by, as I said, going into bonds as the metrics are really looking bad, but this has not been the case in any of those years. Stock markets were always attractive. I might go into gold or silver. If it goes too shaky, I have very few small percentage now in a gold mine and in physical silver as a one-to-one ETF, but that's only 5% of the fund. And the other thing is that I consider, of course, the Buffett companies, the franchises, the Fuchs Petrolubs, the Nestle's, the Coca-Colas, or whatever you have, or even small, good German companies, much more safer than cyclical companies, and that's the other part of risk. And I did go into cyclicals counter-cyclically last year. I mean, I increased actually my weight in the cyclicals in the Southern European companies, in the not-so-great average companies, because I found valuation levels that were simply too appealing. So I now would say I have about 40%, 45% in Buffett-like rock-solid long-term business models that even a major global crisis wouldn't shake. And I have
those are the Nestle's of the world and the Coca-Colas.
Right. Or even mid-caps like Fuchs Petrolub or something like this is a favorite of many friends of mine and myself. And they're doing the lubricants globally and they're family-owned and run. So these companies, I mean, don't have to be the large caps, but really, really solid business models.
Okay.
And those are not too much undervalued right now. They're undervalued. They're fairly valued. They're undervalued by maybe 20, 30%. But I still have that because, as Buffett said, it's better to have that great business at a fair price and a great business at a fair business at a great price. So again, he tells you not the whole story. So those great businesses are still attractive to have, and I view them also as hedge. Let's say if inflation comes, basically looking into the future, we have the deflationary and the inflationary scenario. We don't know which one will come. That's the real challenge to stock market investors. And
do you have a view on it? Do you favor one over the other?
I have a hope. I hope central banks will be able to create inflation. I hope it, because deflation would be horrible to the world economy. So I said this as early 2010, and then April 2010, Rogoff said, no, not Rogoff, the French IMF chief economist said the same thing, and I hope we'll get inflation going to some extent, although it will be very difficult to put it back into the bottle. But I don't see any other way to deal with global debt. Its growth alone will not do. And so my fund is positioned that if that is the case, it will do very, very well. If we get deflation, it will not do so well. It will get hurt, but it will survive. I mean, and again, I took a choice. I could stand off to the sidelines completely, which is what others do, but that's the way I deal with that risk.
And so you mentioned about half of the portfolio in these high quality franchises, even at a fair price, and the other half, can you just walk us through your thinking there?
Yes, I mean, there's so many dirt cheap companies. I was not above buying Commerzbank a couple of weeks back at 1.47 average entry. Commerzbank is the second largest German bank. It's not in a very good position right now, but it trades at 1/3 book. It may have to have a capital increase. Of course, there's the new core capital regulations, all of this, but the stock comes from 30 something, it went down to €1 almost. It's systemic, so the German government will not let it go, and I'm not above buying a small position in this. So I had 0.7% in Commerzbank, and it's paid off already. Yesterday it was up 35%, or this morning. Right now it's only up to 26%. I was thinking about selling it. I didn't, so now I'm 10% below, but it's all still up 26%, and I probably sell it at 50% plus. So there's just so many of these dirt cheap, somewhat troubled but not catastrophically troubled businesses that the relation to price and risk is so rewarding that I do those all the time. Or Benetton, which is of course a more, as a retailer of clothing, it's a more stable business. They're not in great shape, but they're not in terrible shape. PE of 7, dividend yield of 7, way below book, around I would say less than half book. So I buy them. I might sell them pretty quickly again if they give me 30–40%. Right now we have this panic in Europe, so I have lots of those positions.
So those could be lesser quality businesses that may have a fundamental issue, but they are available in your view at a very low price, and that is an opportunity.
Yes, those are not turnarounds in my sense, but they're companies dealing with headwinds. One I like a lot, which I've been buying on and off and mostly making money, is Deutsche Lufthansa. I know Buffett says a lot about the airline business, how difficult it is and so on, but again, it's a tough business. It's an oligopoly. Deutsche Lufthansa is certainly one of the best companies in the business. If I buy it at 55% book, I buy it. I've presented it at various investment conferences 2 or 3 years ago. It went up, I sold it. It went down, I bought it again.
So these are again your trading names where you are not afraid to have a short holding period based on specifically where you enter and then depending on the price movement.
Of course, it can go the other way. I mean, you can sometimes. I wanted to make the quick profit, but I have to hold them a longer time. I have, for example, Italmobiliare, which is a real estate, and they hold the majority in Italcementi, the great big Italian cement manufacturer. They hold some other holdings. They're way below, around 1/3 of book value. Have been around for a long time. Not doing. I mean, the earnings situation is not so great right now. and I've had them now for 2 years, and I have a minus of 20%. They fell even lower 2-3 months ago. I bought some more. So sometimes, of course, those don't work out and you have to hold them for a longer period of time, but then you have to be prepared to do that. I guess that's what also Buffett means. If you're not prepared to hold them for a longer period, then it could be a problem. I mean, honestly, I'm not sure how long I'm prepared to hold Benetton, but fortunately the position is in plus.
Can we now step back again a bit and just talk a little bit about, so just what are your goals for PI Global Value? Where do you see it in 5 to 10 years?
Right. Right now, it's been around for not quite 4 years, and return has been around 36%. We were at 56% a year ago, but due to my philosophy and true to my philosophy, I was fully invested all the time, and of course, the downswing in Europe hit me. So down from 56 in 3 years to 36 in 4 years. Well, I would hope to have an annualized return of 13%. Maybe if I exceed my expectations, maybe I can go up to 15, but that would be stretching it. So if I do 13% annualized return, I would be very happy. And of course, we've thought about, I mean, I get known in Germany and surrounding countries. We thought about closing it at some point. I even now, of course, in small caps, I even now feel sometimes volume restrictions. But right now, there's still so many good opportunities out there that we haven't set a figure where to close the fund. And with we, I mean my bank partner and I, we are aware of the issue, but right now we could go easily up to a couple of $100 million and not have problems with finding investment opportunities. But at some point, of course, that would stop.
Mm-hmm. And we talked about some of the mistakes that investors make. I'd just be curious to hear, in your opinion, what is the single biggest mistake that you think keeps investors from reaching their goals?
Not knowing themselves.
So
let me elaborate a bit. I know myself. I'm impatient. So at some point I like to trade. So if I just stick to long term, I have a friend who does really long term, small cap, mid cap, growth companies, makes maybe 3 trades a year, does very well. That's not me. So I'm impatient, so I have to do something sometime. I mean, I try to hold myself back, but very often if you look, you find relative trades that are appealing. And so Buffett, long-term, yes and no. I know I have to find ways to deal with my impatience, and one of them is trading, if it makes sense. If it makes sense, I mean, not constantly doing big trades every day, and but maybe once a week I do something. And that's just me, and it works for me. So really you have to know yourself, you have to reflect what others do, does it really suits you? And once you've known yourself, you really have to stick to your style.
Mm-hmm. And you also mentioned Bruce Greenwald and Warren Buffett and how they influenced you. Can you perhaps mention a few books that you found particularly helpful in honing your investment judgment, either from either from Bruce Greenwald or other people that have influenced you?
Not so much investment books. I mentioned I'm interested in history. I read history books. I read philosophy of history. I think that is very important to see that there's nothing new really under the sun. Things come back in different shapes, and metamorphoses over time, and so history really has been my teacher. And as came through in this conversation, my evaluation methods are what some people would consider them fairly crude, but they work and they're robust. That's the point. So in terms of straightforward investment books, the one and first book really is The Intelligent Investor by Ben Graham. It's not so much a cookbook, but really a book that teaches you how to think about investing. And so that's my first recommendation. And in terms of technique, I do find Greenwald's value investing very helpful, because he helps you to focus on average companies and growth companies, make distinctions between those cases, step back. There's also other good value investing books. Charles Brandes wrote a pretty good book a few years back, Value Investing Today, which I like, but Greenwald and Graham are still my favorites.
Great. Well, on that note, Max, thank you very much for your time and the insights you shared with us today.